You're listening to Witham's Taxing Topics. When it rains, it pours. Tax regulations and guidance are dynamic, continually changing domestic and international financial waters. Step under Witham's umbrella to better weather the storms of trending taxing topics. We'll share the essential news and information you need to prepare for what's ahead.
Good day to wherever you are. My name is Derek White. I'm a principal at Witham, specializing in tax. In industries that I specialize in are food and beverage, restaurant, amongst others. And some of the things that we're seeing, and never get old anyway, around topics related to structure. Like, how are you structured? There are legal considerations, there are tax considerations, and what you might decide today may not be what you need 5, 7, even 10 years from now. But what we'll talk about today is things that you want to consider as you're setting up your business or as you're a maturing company and going through some of the growing pains of, is the current structure working for me? And so what we want to talk about is some of the common structures that we see. And so many of our clients in this industry form legal LLCs. This gives them limited liability protection should the company have an issue. What this does for us on the tax side is offer us great flexibility in providing us a way to say, well, do we want to be taxed as an LLC, which means does the income flow through to the owners? Or can we be taxed as a C Corp, where the income stops and the entity is a taxed corporation? Or are we an S corporation, which is a hybrid of both of these? And the income flows through to the owners, but there are corporate components. And so we'll talk about each of them. So some of the reasons why people love LLCs is the flexibility. LLCs can own any kind of company, and anyone can own an LLC. That's the beauty of it. You can have a foreign owner, you can have an entity own an LLC, and so there's great flexibility in that. A lot of investors like the LLC because they can benefit from the income or the losses that are generated within the business as the business goes into its life cycle. In this industry, we don't see a lot of C Corps. It's just not a structure that we see many entities go through. But this also has great flexibility. A lot of VCPE firms like C corporations for future acquisitions. And so what we see with this is it also has great flexibility in ownership. The issue with a C Corp is that if you as an owner want to pull money out of the C Corp, you are taxed on that, as well as the corporation being taxed on the income. So this idea of double taxation comes into play. It's really easy to put things into corporations, it's really hard to take them out. But again, if you have future acquisitions, you may have a C Corp as an idea. S Corps are really great when you want to have a tax savings component. These are meant for small businesses. And so in doing this, you do have much more of a lack of flexibility versus an LLC. And so with an S Corp, you have this opportunity to remove a layer of tax that you'll see if you own an LLC. LLCs are taxed on its profit on regular income tax rates. They're also taxed at self-employment tax rates. And so you have this extra pickup with respect to tax that you'll see if you're an LLC owner. The S corporation takes away the self-employment tax. You can be saving 12 to 15% of tax on your income as an S corp. But by having an S corp, you also have greater limitations on who can own an S corp and what kind of businesses can an S corp own. And so S corp owners have to be individuals. They cannot be an entity like an LLC or a corporation. Some trusts can own S corps, but they have to feel and look like an individual person. And you can have no foreign owners, so they have to be U.S. citizens in order to be an S Corp owner. And so you can see there's great limitation here. S Corps can own other LLCs And if they are 100% owned LLCs, they can make those LLCs S Corps too. So there's some great tax savings. So for our California clients who have S Corps and LLCs as subsidiaries, we can save a lot of money through creating S Corp subs, doing it that way. But again, LLCs have the great flexibility. S Corps have far little flexibility, but greater tax savings. Some other key considerations that you want to think about when it comes to the structure of your business is, how do you want to be paid? If you are an investor and you are the one running the business, or a person running the business, you have to understand how to get paid. A lot of people like W-2s. They don't have to think about anything. They just do with the withholding, and that's it. But if you have an LLC and you're an investor of that LLC and you want to be comped out of that LLC, you cannot be an employee. There are tax rules that prohibit this. And so you want to understand that when you want to be compensated, you need to do it through what we call a draw or guarantee payment. This is the far more expensive route because of the fact that you need to take this as self-employment income and regular tax. And so that's the drawback with an LLC in terms of compensating people who run their business. S Corps, you can be paid a wage, which is great. So just run it through payroll as a reasonable compensation. And that makes it pretty easy to do. So when it comes to some of the structures we see, because the LLC has a far more expensive tilt to it when it comes to taxes, you might see restaurants or food companies who are looking to expand and have multiple entities. What they might do is they might have a management company that's all it does is manage. And so that might be an S Corp, and you might run management fees through that, pay everyone out of that entity. That gets around some of the self-employment issues. A lot of restaurant clients like to put an S Corp as a management company above any restaurant location entities because of this. We can run through the profits and take away the self-employment tax while paying those who manage the companies. But when we think about the future of your entity and your brand, the issue is, well, does an S Corp or an LLC or a C Corp give you some of that flexibility and ability to go out to market, if depending on how you want to either raise money, exit your business, or bring on new investors. So S Corps are limited in some of the things it can do because of the ownership. So if you have like a VC firm that wants to buy your brand, the question will be, will the S Corp survive? So that's some key considerations there. LLCs are easy for that. C Corp's the same. Some of the things that you want to consider are, what do we do with current investors? And so one of the drawbacks of the S Corp when you compare it to LLCs or C Corps is this idea of pro rata allocations. An S Corp has restrictive rules that state you need to allocate income and distributions, and upon a liquidation, equal allocations of proceeds on a liquidation to each owner based on their ownership. An LLC or a C Corp, you can build in preference items that give people preferential treatment over other investors. The S Corp, you can't do that. And so that's what makes an S Corp such a difficult entity structure to have when it comes to allocations of distributions, allocations of liquidations, because you have to give everyone a fair share of their ownership. So in other words, you cannot create a preference item. You can create multiple classes of stock, non-voting and voting in an S Corp, but each share must be viewed the same from an economic standpoint. And so again, why LLCs and C Corps are more popular, because of that flexibility of saying, well, I can give someone a preference over someone else when it comes to liquidations or allocations of income or loss. And so those are the big items that you wanted to touch base on with respect to structure. One more item we want to talk about is state taxes. So as you look at individual states, some states don't honor an S Corp without an affirmative election. Some don't even consider it at all. And so you have to be careful. As an example, New York State will say you are defaulted as a C Corp if you're a federal S Corp until you affirmatively elect. So you have to go through a process of understanding, well, do I want to do an S Corp in New York? States, California, they'll honor the S Corp if it's done on a federal level. So again, we talked about this from a tax standpoint. So again, we were a legal LLC. Legal LLCs can elect to be a C Corp, or they can elect to be an S Corp. If you decide that you want to set up your corporation, your entity as a legal corporation, and you stay your LLC, then you have to switch to a C or S Corp. If you're already one of those, then that's not usually a big issue with respect to your current status. And so again, we have to first look at what you're legally going to do. Then after that, it'll be, well, what do we want to do for tax purposes? And so having the discussion with your attorney and your tax advisors at the same time is critical with respect to your structure. And as I mentioned before, what you choose today may not be what you want to do in the future, but that's just a few pieces of information just to know as you go into how do I want to structure my business today if I'm starting it out? How do I want to structure it if I have a potential future sale, or maybe it's just this isn't working for me anymore, and we just need to consider what other structures are out there. And so having a tax advisor that can walk you through those, Witham has those, we can walk you through any kind of structure conversation that you need along with your attorneys. So again, my name is Derek White, principal at Witham. Thanks for taking the time to listen.
You've been listening to Witham's Taxing Topics. Contact us with your feedback or suggestions for future podcast topics. Visit www.witham.com for additional information. Send an email to info@witham.com or follow us on Facebook, Instagram, or Twitter @WithamCPA. Thank you for listening.